Unbiased Reveal channel. I'm Jenny.
And I'm Peter.
Okay, so let's unpack this whole situation. You know how October is usually like the big month for crypto? Uptober, right?
Right. Traditionally very bullish.
Yeah. Well, this year, literally at the finish line, the market just took a nosedive. It turned the whole thing into, well, a Halloween horror show, basically.
It really did. We saw this sudden, pretty broad slump. Bitcoin, Ethereum, altcoins, everything got hit around, what was it, October 30th, 31st?
Exactly. And the main events were pretty dramatic. Huge liquidations, like over $1.2 billion.
Massive. And at the same time, you had significant institutional money, the ETFs and these DATCO things, heading for the exits, hundreds of millions out.
So the mood just shifted instantly to, like, pure fear, even though, and this is the confusing part, we actually got what sounded like good news from the Fed.
Yeah, that's the core conflict, isn't it? A rate cut happens, but the market reacts like it's poison. Why did good news feel so bad? That's what we need to figure out.
So our mission today, for you listening, is to cut through all that noise. We're going to connect the dots, interest rates, those ETF flows, the leverage trading, to give you the sort of insider view on why Uptober went bust so spectacularly.
Let's get into it.
Okay, so the macro picture first. The macro handcuffs, as we're calling it. The Fed actually did deliver. They cut rates by 25 basis points, which is what people wanted.
Right, the doves were expecting that. And maybe even more importantly, they confirmed the end date for quantitative tightening, QT, for December.
And just to remind everyone, QT is basically the Fed sucking money out of the system. So ending it means liquidity should be coming back.
Exactly, turning the taps back on, which for assets like crypto that thrive on liquidity should be, incredibly bullish news.
Should be. But then Chair Powell steps up to the microphone.
Yes. And delivers this very cautious, almost hawkish twist. It was like they gave a gift with one hand.
And then immediately warned it was radioactive with the other.
Precisely. He pretty much hinted that another rate cut in December is, and I think the quote was, far from guaranteed. That immediately poured cold water on everything.
Hold on, though. If they just cut rates, why does the next potential cut or lack thereof cause such immediate panic? Isn't the current relief enough?
Well, markets are always looking ahead, right? It's all about expectations. Powell essentially told traders, don't count on this easy money continuing.
Okay.
And that caution just rippled out. It triggered a wider risk-off move. Big money started pulling back from anything seen as volatile.
So that's why the good news felt so bad. The Fed's still signaling, hey, we're worried about inflation long term, even with this cut.
Exactly. Vigilance is still the watchword.
And what's really interesting, maybe concerning for that whole crypto as a safe haven idea.
Oh, absolutely. Bitcoin and other major cryptos fell right alongside U.S. stocks.
Yeah.
Which sort of extinguishes that hope, at least for now, that crypto can decouple and act as a safe haven when traditional markets get shaky.
Didn't we just see data saying the Bitcoin-NASDAQ correlation was near zero?
We did. Which makes this simultaneous crash even more striking. It suggests that when there's real broad institutional fear, a genuine panic, that non-correlation theory just evaporates.
It's like the saying, when the flood hits, every boat sinks together.
Yeah.
Doesn't matter how uncorrelated they seem before.
Spot on. And even other potentially good news, like things calming down a bit on the U.S.-China trade front, tariffs paused.
Yeah, that usually helps crypto a bit.
Usually. But this time, completely overshadowed. The Fed's stance, Powell's cautious words, just drowned everything else out. It's all about monetary policy right now. The signal is, be careful.
Okay, this macro fear is setting the stage. Before we look at the carnage in the crypto markets themselves, just a quick note. If you're trying to navigate these, let's say, choppy waters, we've put our preferred crypto referral link down in the description for you.
Good point. Okay, so macro fear established. Now, the crypto carnage itself, where did this fear hit hardest? The derivatives market. That was ground zero.
Right. And the numbers are staggering. You mentioned $1.2 billion. Some reports say up to $1.3 billion in positions just liquidated, gone, in 24 hours.
And it was overwhelmingly the longs, the people betting the price would go up. One report I saw showed something like 764 million in longs wiped out compared to maybe 120 million in shorts. It was very one-sided.
It's just such a brutal reminder of The risks in leverage trading. We've said something like this before, but it bears repeating. Leverage is like the financial equivalent of a high-speed car crash, except instead of airbags, you get a liquidation alert.
That really captures it perfectly. And, the market was already fragile. There was that huge leverage clear out just a few weeks before, remember? October 10th?
Oh, yeah, the Black Friday event wiped out like $19 billion.
Exactly. So that cleared out some leverage, but it also left the market really jumpy, really sensitive to any bad news.
Yes.
It basically set the stage for this bloodbath.
It wasn't just retail traders getting wrecked, was it? The institutions were heading out too.
Definitely. The ETF outflows were significant. Net outflows from U.S. Bitcoin ETFs hit, $470 million, and Ethereum ETFs saw over $80 million leave, too.
That signals real caution from the big players. They're either taking profits off the table or, maybe more worryingly, actively hedging against more downside.
And this also basically sealed Bitcoin's fate for October. It's now set for its first losing October since 2018. That ends that 7-year Uptober winning streak.
Wow. End of an era, sort of.
Feels like it. Then there's this other weird kind of complex piece, the Deet and Wine saga, these digital asset trusts, or DATCOs.
Right. Explain this again because it seems almost backward.
It is a bit strange. So a DATCO, like, say, ETHZilla, holds a ton of actual crypto Ethereum in their case, but their shares trade on regular stock exchanges.
Okay.
What we saw was some of these firms selling off chunks of their actual Ethereum holdings, like $40 million worth, to raise cash.
To do what?
To buy back their own stock. They were liquidating crypto to prop up their traditional share price.
That seems unsustainable.
Highly. And it highlights a risk. The stocks of these DATCOs, like BMNR, ORBS, SBET, they've already crashed, like over 70% from their peaks. It shows the model's pretty fragile.
So institutions are choosing to save their stock price over holding on to their crypto.
In some cases, yes. It shows where priorities lie when things get tough. And it creates this weird dynamic leading to a specific institutional trade idea that's floating around.
Which is?
The suggestion is to hedge by going long Bitcoin, but short Ethereum.
Why short ETH specifically?
Partly because of these DATCO mechanics. Their ability to buy more ETH to support the price is limited because retail demand for their actual shares is slow. So it puts this kind of artificial downward pressure on ETH compared to Bitcoin, making it a target for shorts in this environment.
Fascinating. Okay, so institutional jitters, weird DATCO mechanics. Let's shift to the pure technicals, the charts and the options market.
These were flashing warnings too, right? Oh, definitely. The options market, especially with that massive $16 billion expiry looming on Halloween, October 31st, that alone was driving a lot of short-term hedging and volatility.
And what were the options traders actually doing?
They were leaning bearish. The volume split was pretty clear. About 56% of the volume was in puts bets on the price going down versus only 43% in calls, which are bets on the price going up.
So the pros were already hedging for weakness before Powell even spoke.
Seems that way. They were anticipating or protecting against exactly this kind of drop.
Okay, now let's look at Bitcoin's chart. It's doing a bit of a tightrope walk right now, isn't it? Around $109,000.
It is. And a really crucial support level everyone's watching is that zone between $107,000 and $108,000.
Why that specific zone?
Because it lines up almost perfectly with a major technical indicator.
Yeah.
The 200-day exponential moving average, the EMA. Right now, that's sitting at about $108,353.
And why is the 200-day EMA such a big deal?
It's psychologically massive. For big funds, for technical analysts, it's often seen as the line in the sand between a long-term bull market structure and, well, a bear market.
Oh, losing it is bad news.
Very bad. If Bitcoin breaks decisively below that wider $104,000 to $106,000 support band, which includes the 200-day EMA, that's seen as genuinely dangerous, it could trigger a much faster sell-off, potentially taking us down to retest that big psychological $100,000 level.
Oof, okay. And what about Bitcoin dominance, that metric showing DTC's share of the total crypto market?
Yeah, that's crime again, nearing 60%. And this reinforces that other sort of golden sentence we sometimes hear. BTC's market dominance breaching 60% confirms the flight to safety within crypto, draining capital from altcoins.
So money isn't necessarily leaving crypto entirely, but it's consolidating into Bitcoin as the perceived safest crypto asset.
Exactly, which puts the squeeze on altcoins.
And we're seeing that with Ethereum, right? It broke a key level.
Yeah, ETH broke down below its $3,917 support pretty hard. It fell quickly towards $3,700. $2,600. That's a significant technical break.
Where can it go from here, short term?
The immediate downside target is around $3,650. One analyst even suggested ETH could see a much sharper drop, maybe down towards $2,000.
Wow, $2,000.
Yeah, a major retracement before potentially resuming its climb towards, say, $10,000 later on. It just highlights the potential for extreme short-term volatility right now.
Is there any good news for ETH in the charts or data?
Well, the underlying structural bias, if you look at options pricing further out what they call implied volatility and long-term contango, that still suggests institutions see long-term upside potential. They might be shorting it now, but they still believe in the longer story.
Okay, so short-term pain, potential long-term gain. That seems to be the theme. Let's try and consolidate this. We've seen the macro fear, the liquidations, the institutional moves, the technical breaks. Where does this leave us? Best case versus worst case scenario moving forward. Let's start with a grim one, the worst case.
Okay, the worst case is basically more the same. Continued institutional fear, persistent ETF outflows through November, Bitcoin losing that crucial $104,000 support.
Which could accelerate the drop.
Right, and because crypto is currently stuck tracking stocks, if worries about, say, AI spending hitting tech stocks continue, that keeps weighing on risk appetite generally. Money flows to traditional safe havens like gold and away from digital assets.
So potentially rough November if that plays out. Okay, flip side. What's the best case scenario? Is there a silver lining here?
The best case relies heavily on looking a bit further out at the structural positives. The most immediate one is that confirmed end to quantitative tightening in December.
Right, the liquidity tap turning back on in early 2026.
Exactly. Historically, when liquidity returns to the market, risk assets like crypto tend to rebound strongly. That sets the stage.
And what about the bigger picture, the institutional narrative?
That remains incredibly bullish, especially for something like Ethereum. Even with this current price drop, you have major players like Standard Chartered putting out reports predicting the tokenized real-world asset sector, RWA, will be huge.
RWA, like tokenizing real estate, bonds, that kind of thing?
Precisely. They're projecting that market could reach $2 trillion by 2028. And crucially, they expect most of that activity to happen on Ethereum. That's massive, tangible utility coming online.
That RWA story is definitely powerful. So the advice in the best case is?
Use this dip, this consolidation period, to actually do your research. Look into these emerging sectors that are building real utility RWA, prediction markets like Polymarket, smart agents. Focus on the fundamentals while everyone else is distracted by the price swings.
And it's not like all institutional money is fleeing alts, right? You mentioned Solana.
Yeah, that's a counterpoint. Solana ETFs are still seeing inflows, which is interesting. And you had the CIO of Bitwise recently comparing Solana's growth potential now to where Bitcoin was in its early days. So there's still selective institutional interest in promising altcoins.
Okay, let's try and wrap this all up. Time for a summary.
All right, so today's deep dive showed that this Halloween market plunge wasn't just some random glitch. It was really a perfect storm, wasn't it?
Felt like it. A collision between those surprisingly hawkish Fed comments.
A huge unwinding of leverage in the derivatives market.
And institutions seemingly taking profits or de-risking just before that big options expiry date.
So now the crypto market is kind of stuck. It's caught in this tricky consolidation phase. You've got the short-term pain from all this macro uncertainty.
Versus this incredibly optimistic long-term vision. You know, the idea of crypto becoming mainstream, stablecoins rivaling parts of the dollar supply, Bitcoin challenging gold's market cap.
That huge adoption thesis is still intact, but navigating the short-term chop is the challenge right now.
And the immediate trigger for a lot of the chaos, the mechanism that failed spectacularly, was that excessive risk. I think that phrase we highlighted really nails it.
Yeah, the one about leverage. Let's say it again. Leverage, the financial equivalent of a high-speed car crash, except instead of airbags, you get a liquidation alert.
It perfectly captures the suddenness and brutality of those liquidations.
It does.
So this leaves us, and you listening, with a pretty important question to think about. Given this split, the strong institutional focus on long-term fundamentals like RWA versus these persistent short-term macro worries from the Fed, where should your focus be?
Should you be prioritizing the research into that future utility, digging into things like Ethereum's RWA potential? Or is it smarter to wait out the storm, focusing more on the immediate macro warnings until the uncertainty clears?
What stands out to you as the most important signal right now? Let us know what you think.
We'd love to hear your perspective.
Absolutely. Well, thank you for joining us on this deep dive. And just a reminder, we do have the best crypto referral link for you down in the description.
Check it out.
Welcome to subscribe to my channel and like this podcast so that I can continue to make more podcasts. Remember, none of this is investment advice. Always do your own research.